Grow a mushroom, grow a broccoli, grow a plant, grow a fruit tree. Are we supposed to be talking about growth investing? Well, you need to eat good to keep your mind sharp for investing. Welcome to Financial Guru, and we're going to learn about today. What is growth investing? Evaluating a company's potential for growth through learning metrics to figure out growth potential. Value versus growth investing. Example of growth investing or growth stock. We will also learn what growth at a reasonable price investing is, and some final comments on growth investing. Remember to smash the like button and subscribe to the channel to make the financial world a better place for you and me by gaining knowledge. Let's begin to grow step by step up the ladder to success in stocks. What is growth investing? Growth investing is investment style and strategy that is focused on increasing an investor's capital. Growth investors typically invest in growth stocks that are young or small companies whose earnings are expected to increase at an above average rate compared to their industry sector or the overall market. Growth investing is highly attractive to many investors because buying stocks in the emerging companies can provide impressive returns as long as the companies are successful. However, some companies are untried and thus often pose a fairly high risk of the potential for much higher returns. Now let's understand growth investing. Growth investors typically look for investments in rapidly expanding industries or even entire markets. When new technologies and services are being developed, growth investors look for profits through capital appreciation, which are the gains they will achieve when they sell their stock. In fact, most growth stock companies reinvest their earnings back into the business rather than paying a dividend to their shareholders. These companies tend to be small, young companies with excellent potential. They may also be companies that have just started trading public. The idea is that the company will prosper and expand, and this growth in earnings or revenue eventually translate into higher stock prices in the future. Growth stocks may therefore trade at a high price earnings PE ratio. The company may not have earnings at this present moment, but are expecting to be in the future in terms of net income. This is because they may hold patents or have access to technologies that put them ahead of others in the industry. In order to stay ahead of the competitors, they reinvest money to develop even newer technologies, and they seek to ensure patents as a way to ensure longer-term growth. Because investors seek to maximize their capital gains, growth investing is also known as a capital appreciation strategy. Growth investing on its own can be scary and highly risky, so mixing value investing into the equation is a way of lowering your risk by buying the stock at a lower price, often shortly after IPOs, meaning soon after the company goes public on the stock exchange. The stock price often drops after skyrocketing and then recovering fairly quickly. As early investors and company executives take their profits, then most stocks stabilize and growth begins. Growth stocks often move in price quicker, but not always. Now we should evaluate a company's potential for growth. Growth investors look at the company or market's potential for growth. There is no absolute formula for evaluating this potential. It requires a degree of individual interpretation based on objective and subjective factors, plus personal judgment. Growth investors may use certain methods or criteria as a framework for their analysis, but these methods must be applied with a company's particular situation in mind, mainly their current position, its past industry performances, and historical financial performance. In general though, growth investors look at 5 key factors when selecting companies that may provide capital appreciation. These include strong historical earnings growth. Companies should show a track record of strong earning growth over the previous 5 to 10 years. The minimum earnings per share EPS. Growth depends on the size of the company. For example, you might look for a growth at least 5% for companies that are larger than 4 billion. 7% for companies, I would go for something more like 20% growth at 4 billion is where I look. That's more conservative side. 7% for companies in the $400 million to $4 billion range, and 12% for smaller companies under 400 million. While if you're in some countries, you cannot even get into the stocks till they get to about $1 billion. So it makes it hard to catch the lower end growth unless you live in that particular country. The basic idea is that the companies have displayed good growth in the recent past. It's likely to continue doing so moving forward. Strong forward earnings growth. An earnings announcement is an official public statement of a company's profitability for a specific period, typically either a quarter or a year. These announcements are made on specific dates during earnings season and are preceded by the earnings estimates issued by equity analysts. Those are people in the industry look at stocks, sort of like a journalist is one way of looking at it, analyzes the stock and gives their opinion on what the estimated earnings is going to be. It's these estimates that growth investors pay close attention to as they try to determine which companies are likely to grow at above average rates compared to the industry. Next, strong profit margin. A company pre-tax profit margin is calculated by deducting all expenses from sales, except taxes, and dividing by sales. It's an important metric to consider because a company can have fantastic growth in sales with poor gains in earnings, which could indicate management is not controlling cost and revenue. In general, if a company exceeds its previous 5-year average of pre-tax profit margin, as well as those of its industry, the company may be a good growth candidate. Next, we're going to look at strong returns on equity, or the ROE. A company's return on equity measures its profitability by revealing how much profit a company generates with the money shareholders have invested. It's calculated by defining net income by shareholders' equity. A good rule of thumb is to compare a company's present ROE to the 5-year average ROE of the company and the industry. Stable or increased ROE indicates that management is doing a good job generating returns for shareholders. Investment and operating the business efficiently. You can find our financials on Seeking Alpha and numerous other sites on the web. Now let's look at strong stock performance. In general, if a stock cannot realistically double in 5 years, it's probably not a growth stock. Keep in mind, stock price would double in 7 years with a growth rate of 10%. To double in 5 years, the growth rate must be 15%, something that certainly is feasible for younger companies in the rapid expanding industry. That was a look at 5 key areas for growth investing. Now let's compare growth investing to value investing. Some consider growth investing and value investing to be totally opposite approaches. Value investors seek value stocks that trade below the intrinsic value or book value. You can check out more of this on my value investing video on this YouTube channel. You're welcome to check it out. Whereas growth investors, while they do consider a company's fundamental worth, they tend to ignore standard indicators that might show the stock to be overvalued. While value investors look for stocks that are trading for less than its intrinsic value today. Bargain hunting, so to speak. Growth investors focus on the future potential of the company, with much less emphasis on the present stock price. Unlike value investors, growth investors may buy stock in a company that are trading well higher than their intrinsic value, with the assumption that the intrinsic value will grow and ultimately exceed current valuations. But there's nothing stopping you from mixing some value strategies with growth investing, especially in terms of price. Now it's time to look at another growth model by Peter Lynch, as manager of Fidelity Investments' legendary Magellan Fund. Pioneered a hybrid model of growth and value investing, which is now not commonly referred to as growth at a reasonable price. What is growth at a reasonable price? It is an equity investment strategy that seeks to combine tenets of both growth investing and value investing to select individual stocks. Growth at a reasonable price, investors look for a company that is showing consistent earnings growth above broad market levels while excluding companies that have very high valuation. The overarching goal is to avoid the extremes of either growth or value investing. This typically leads GARP investors to growth-orientated stocks with relatively low price-to-earnings ratios, the PE ratio, multiples in the normal market conditions. Understanding growth at a reasonable price. Investing was popularized by legendary Fidelity manager Peter Lynch. While the style may not have rigid boundaries for including or excluding stocks, a fundamental metric that serves as a solid benchmark is the price-to-earnings growth PEG ratio. The PEG shows the ratio between the company's PE ratio valuation and its expected earnings growth rate over the next several years. A GARP investor would seek out stocks that have PEGs of 1 or less. which shows the PE ratios are in line with expecting earning growth. This helps to uncover stocks that are trading at a reasonable price. In a bear market or other downturn in stocks, one could expect the return of a GARP investor to be higher than those of a pure growth investor, to strict value investors who purchase shares at PE ratios under broad market multiples. GARP strategy. One of the simplest ways to utilize the GARP strategy is by investing in an index fund that utilizes the strategy. Utilize the strategy. This removes having to analyze your own stocks and come up with investment that fits the criteria of a GARP investment. Standard & Poor's has created the S&P 500 GARP index, which is an index that tracks companies with consistent fundamental growth, reasonable valuation, solid financial strength, and strong earnings power. One fund that tracks the S&P 500 GARP index is the Invesco S&P 500 GARP ETF, or SPGP. It is an exchange-traded fund that aims to invest 90% of its assets into the securities that make up the S&P 500 GARP index. The fund's largest holdings are in the financial industry at 27%, followed by information technology stock 20%. Healthcare is the next heavily invested sector at 15%. These all change from month to month, week to week, but they'll be around this area. The smallest invested sectors in well-known stocks included are Facebook, Viacom, Adobe. The fund also comes with a low expense ratio of around 0.34%, making it an affordable investment choice. I personally would buy individual stocks, as I believe I can make more money this way, because you can buy the stock at a cheaper price and load the boat, compared to a ETF or index fund that is all chopping and changing all the time, trying to keep up with the other index funds in the similar categories, which lessens your profitability. Let's go on to an example of a growth stock. Amazon Incorporated, AMZN, the ticker number, has long been considered a growth stock. In 2021, it remains one of the largest companies in the world and has been for some time. As of Q1 2021, Amazon ranks in the top 3 US stocks in terms of its market capitalization or market cap. Amazon stock historically traded at a high price to earnings ratio. Between 2019 and early 2020, the stocks had remained upwards of 60 in 2021. Despite the company's size, earnings per share EPS growth estimates for the next 5 years still hover near 30% per year. When a company is expected to grow, investors remain willing to invest, even at high PE ratios. This is because several years down the road, the current stock price may look cheap in hindsight. The risk is that growth doesn't continue as expected. Investors have paid a higher price expecting one thing and not getting it. In such cases, a growth stock price can fall dramatically. I had Amazon in the past, but sold out at a nice profit, but it continued to rise due to the Rona. But the price is well over what I'd like to pay now. Time is unfortunately up today for this episode. Thank you so much for joining me on your growth journey to financial freedom. Remember, I am not your financial advisor. Seek professional help before investing into any stock. Bye bye for now, as I grow on the tree of life to find the money tree we have all been searching for. Take care.